We sit here, almost through the month of September. S&P up 20% year to date. Everybody was dusting off the post-Fed rate cut playbook after the initial ease. What does it all tell you at this point in terms of what's priced in and how the macro is tracking?
So far, look, the best thing about September is that we weren't down, right? S&P volatility is very well known to be pretty bad in September, and we're up 1.6% on the month. So after some choppiness at the start, we recovered really nicely, and that's a great thing to see in what's usually a volatile month. On the macro side, we're seeing some good revisions. GDP Now, the Atlanta Fed model, just took its Q3 estimate up to 3.1% today. So the economy is tracking pretty well. Gasoline demand up 6% year over year for the most recent week. That data was out on Wednesday. Also shows pretty strong consumer activity. And then we're also seeing initial claims. Yesterday's data is looking very solid, down below the 3-year average. So the whole idea of a mid-cycle playbook that we use at DataTrek, I think, very much still holds. The economy is chugging along, the Fed's cutting rates, and there's no obvious cracks or fissures in the story.
Yeah, it all does come together pretty well at this point. I mean, despite the scares we've had along the way. And I guess the question is, can a market that's already been kind of pricing in or feeding off of those dynamics, is it able to continue to do so, to more or less discount a continuation of that trend as opposed to any new, fresh, positive catalyst to go higher?
Yes, I mean, the history of sort of PE multiples and stock prices is pretty clear in that it shows that multiples creep up and prices creep up with them as long as there's nothing obvious to derail the story, as long as there's no really strong negative catalyst, which tends to be the thing that really ends economic recoveries. So, PE multiples are a function of market confidence, investor confidence, and that should continue to hold through the rest of the year. And obviously, we're going into what are seasonally some much better months, particularly after the election for the S&P going to December and the old Santa Claus rally story.
Yeah, for sure. And you wonder if, I'm looking at the volatility index is actually elevated towards 17 here. It just seems like we're going to get within 30 days of the election. You have some geopolitical stuff. Maybe people are going to stay a little bit on edge for those reasons. Although I guess bigger picture, you guys took a look at the 2-year returns of the NASDAQ 100, I guess, are up 67% or so. It's about when the bull market started 2 years ago. And how does that fit in terms of, historical performance and then what you might expect in terms of returns to come?
Yeah, so you're right. And NASDAQ's up 67% over the last 2 years, and we use 2 years as a much better way of thinking about medium-term returns than just 1-year returns. It is substantially higher than the average, no doubt about that. The average is around 25%, so we're chugging along at a pretty good clip off of those lows in October 2 years ago. However, the most important number to know about the NASDAQ is it's got to go up 100% over 2 years in order to indicate really a lot of speculative froth. When it does that, yeah, you're in trouble, but we're nowhere near that level now. So we call it a double is a bubble. When you get a double in the NASDAQ over 2 years, that's when you watch out, and thankfully we're nowhere close to that now.
Yeah, in fact, you can always slice these numbers different ways, but the NASDAQ peaked before that bear market in November of 2021. So we're coming up on the 3rd year. I think over the past 3 years, the NASDAQ 100's up only like 20%. So if you wanted to map it onto what happens in prior bubbles, we probably have some room to go.
Absolutely. I mean, look at the late 90s bubble, 95 to 99. You had a double in a year. So we're obviously nowhere close to that now.
And does it seem like this rotation out of tech is something that we should get used to? Or do you go back to that idea that, hey, the NASDAQ 100 has rarely been kept down for long?
The rotation story still seems to hold, and we're seeing it play through even this month. The cyclicals are doing pretty well. Financials have done well, and obviously some of the rate-sensitive sectors have done well. So I'm thinking that the tech rally probably has to wait until November, December, until that final move at the end of the year. In the interim, investors are still looking to play the more cyclical sectors. That's where the upside story is in an economy that's still growing.
Yeah, and of course, we should always remember it's never necessarily a zero-sum game. Nick, appreciate the time today. Thanks very much.